This paper is going to be on a related idea of liquidity transformation. So we know that liquidity transformation is a key function of many financial intermediaries. Banks are the quintessential example here. They raise super liquid demand deposits, invest them in illiquid loans to small, medium-sized businesses. Since the financial crisis, there's been increasing realization that asset managers also engage in liquidity transformation, although perhaps not to the same extent as banks. And there is an ongoing policy debate about the extent to which liquidity transformation by asset managers might pose risks to to financial stability. And on one side of the debate are basically concerns about the potential for fire sales, where initial kind of like negative performance, underperformance, leads to investors to withdraw money from an asset manager, causing the asset manager to liquidate some of their illiquid assets, exerting negative price pressure, leading to more outflows. On the other side of the debate are basically two arguments. One is that asset managers are simply acting as pass-throughs, buying and selling securities on behalf of the investors. The other argument is that they do, in fact, already have liquidity management programs in place that mitigate all of these risks. Okay. Now, let me be a little bit more clear about what we have in mind by liquidity transformation and how we're going to be trying to measure it. Okay. So what we have in mind is that investors face basically a different price quantity schedule when dealing with an intermediary than when transacting on their own. Okay. So for banks, investors can withdraw unlimited quantities of deposits without any price impact. Right? On the other hand, if they were to somehow transact in bank loans on their own, they would potentially face significant price impact. Now, for banks, we can relatively easily measure liquidity transformation just like by looking at their maturity transformation, right? Because like the deposit, there is a maturity mismatch between their liabilities, the deposits, and their assets, the loans. Right? It's a little bit more difficult to measure liquidity transformation by asset managers because for most of them, there is not going to be a maturity mismatch, but they're still going to be performing liquidity transformation. Okay? Specifically in the setting that we're going to be thinking about of open-end mutual funds, investors basically can transact whatever quantities they want at the fixed end-of-day NAV, right? Without effectively internalizing any price impact that they might be exerting on the prices. And if they were to trade on their own, obviously they would face a different price quantity schedule than if they're trading through the mutual fund. Okay? And effectively what's going to be happening is that the mutual fund is going to be pooling the transaction and liquidation costs across both investors who are not trading in the fund and the investors who are actually trading, either putting capital into the fund or withdrawing it. Okay. So the key idea in the paper then to try to measure liquidity transformation of asset managers is going to be to take a revealed preference approach in a sense. So we're going to look at their cash holdings and argue that the way that asset managers manage their own liquidity helps us shed light on how much liquidity transformation they're performing. Okay? So for example, if they were acting simply as pass-throughs, buying and selling securities on behalf of the investors, there's not going to be any need for them to hold any of their own cash. If, on the other hand, funds are performing substantial liquidity transformation, then they're going to rely on cash to help manage some of these liquidation costs, or mitigate their liquidation costs. Okay? So that's going to be the basic idea in the paper. And we're going to look at it in the context of open-end mutual funds. A few reasons to look at open-end funds. One is that there is significant scope for liquidity transformation. So a good example would be loan mutual funds. These are funds that basically invest in syndicated loans. Okay. An interesting fact about these is that when they trade, they basically settle T+14, while the funds themselves are effectively promising their investors next day liquidity and settlement. Okay. And since you see them growing a lot since the crisis, and in fact, more broadly, a lot of the growth in mutual funds since the crisis has been in asset classes that are less liquid and potentially where there is more scope for liquidity transformation. And the other two reasons are that mutual funds are large and they also hold a lot of cash, so it's potentially interesting just to understand this demand for cash and money-like assets.
One question: if there's suppose there's big volatility of gross, but it all nets out. Is that no, like $1 million goes in, $1 million goes out, there's zero net? Is that no liquidity transformation, or is that a type of liquidity transformation?
So part of it will come from the fact that they're offsetting their netting flows within themselves. When we're going to be looking at the data, we're going to be looking at the volatility of net flows. I'll skip this for interest of time. Basically, the outline for the rest of the talk is to briefly talk about the framework that we have in the paper, talk a little bit about the data, and then get to the results. So in the paper, we have a simple model of optimal cash holdings for a fund, where we think about a fund as facing uncertain liquidity shocks from investors who might withdraw some of their cash, and the fund is optimally setting its cash holdings to manage its costs and manage its liquidity transformation. Okay. I'm not going to go through the model here, but just want to simply go through the key predictions from the model, sort of outline them. The first two predictions look at the dynamics of cash management. Okay. So the basic idea here is that if funds are acting as pass-throughs, there's not going to be any need for them to hold cash. Or stated differently, if the assets were perfectly liquid that the funds were investing in, then there would also be no need for cash. They would always just immediately trade in the underlying. Right? To the extent that funds are actually engaging in liquidity transformation, they might not act as pass-throughs. They might want to use some of their cash holdings to accommodate their fund flows. Okay? And related to that is the idea that in both the cross-section and the time series, the more liquidity transformation funds engage in, specifically the more illiquid assets that they invest in, the more aggressive they will be in using cash to accommodate fund flows. The second kind of set of predictions looks at the level of cash holdings, or specifically the fraction, the cash to net assets ratio. Okay? And here, in the model, we can actually show that the optimal cash ratio is proportional to the fund's expected liquidation costs, or like its price impact. And the idea here is simple, that in the model, there is no time varying returns. So the only reason for a fund to actually hold cash is that it thinks that its alternative is selling illiquid assets, which is going to exert a lot of price impact. Okay? So the more price impact the fund would exert if it were to liquidate its assets, the more cash it would want to hold. Right? And the funds that are expect to incur a lot of liquidation costs are the ones that in equilibrium are going to hold a lot of cash, but they will still exert some price impact. Okay? And in the model tells us, sort of like focuses on three variables that are going to be our key proxies for liquidity transformation, which is the volatility of fund flows. And this is basically sort of investor demand for liquidity from the fund, the illiquidity of the assets, and their interaction. Right? And it's really the interaction that's going to be driving a lot of the results, that if our investors demand a lot of liquidity, and our assets are illiquid, is when we really want to hold a lot of cash to mitigate some of the liquidation costs. The final prediction thinks about the social optimal. Right? So funds are going to hold less cash than a social planner would. The intuition here is simple. It's sort of like the analog of leverage or fire sale externality. A given fund, when it sends its cash, is not going to internalize the fact that if it holds more cash, that raises the prices at which everyone else is able to transact. When we look at the data, we're going to try to think about situations where funds are more likely to internalize their price impact and show that these kind of funds hold more cash. A little bit about the data. So we have novel data set on cash holdings. This comes from SEC Form NSAR, which is a semi-annual questionnaire with basic information about funds fees, investment practices, asset composition. We're going to measure cash as cash itself, which is basically deposits, repo, short-term securities, other than repo, so this is mostly T-bills and commercial paper, and this category of other investments, which in practice actually mostly consists of money market mutual funds. But we'll show that the results are robust to kind of like excluding that category. And we're going to link this to CRISP for more characteristics of funds. And we're going to measure portfolio liquidity as simply the valuated average of the liquidity of the individual securities. We're going to do this both for equity funds and bond funds and present separate results for equity and bond funds. Right. So this is the first set of results that looks at the dynamics of cash. Okay. The dependent variable here is the change in cash over a 6-month period, scaled by assets 6 months ago. The explanatory variables are flows during each one of the 6 months, also scaled by assets 6 months ago. So the interpretation here is dollar for dollar change. Okay. So $1 of flows during the current month T is associated with 23 cents change in cash for equity funds. Okay. This effect persists but declines slowly over time. Okay. The columns 4 through 6 look at a slightly different dependent variable, which is the change in the cash to assets ratio. Okay. So here you see the cash to assets ratio increasing. So it's telling us that it's not simply that funds are scaling their portfolios up and down. It's actually that when they receive inflows, their cash to assets ratio increases temporarily. When they receive outflows, their cash to assets ratio declines. Okay. Similar results for bond funds. Here, $1 of flows during month T is associated with cash changing by 32 cents. And I state these results kind of like here as outflows, but it's really basically symmetrical for inflows versus outflows. Okay. The fact that it's stronger for bond funds is potentially consistent with the notion that these funds are investing in less liquid assets. Right? So we're going to look more closely at this in this next set of tables that interacts fund flows with asset liquidity. For simplicity, instead of looking at monthly fund flows, we're going to look at quarterly fund flows. We get similar results looking at monthly. But we're going to interact quarterly fund flows with the illiquidity of the assets that we started the period with. Okay. What you can see here is that flows during quarter T have a positive effect on our cash holdings. And the interaction with illiquidity is positive and statistically significant. So the interpretation here is that a 1 standard deviation increase in asset illiquidity increases the sensitivity of cash to flows by about 20% for equity funds and about 25% for bond funds. We get similar results looking in the time series at periods of low aggregate market liquidity. Okay. So again, during periods of, this is equity funds, during periods of low aggregate market liquidity, the sensitivity of cash to fund flows is significantly larger than during other periods. Similar point estimates for bond funds, although here not statistically significant. We have a somewhat shorter time series for bond funds. The next set of results looks at the cash to assets ratio. Here it's expressed in percentage points, and all of the variables are standardized, so the coefficients represent the effect of 1 standard deviation change. And you can see that all of our 3 proxies basically for liquidity transformation, the volatility of flows, the illiquidity of the assets, and the interaction of the two are positive, statistically significant, and have larger sizable effects on the cash to assets ratio. Right. I should point out that for funds basically that have very liquid assets, so say they're like 2 standard deviations below the mean in terms of illiquidity, flows basically have no effect on the cash to assets ratio. Okay? So this is basically multiplying the coefficient and the interaction term by 2, by -2, adding these up together. So for that kind of fund, flows don't have any effect on the cash to assets ratio. It's really only for funds that invest in relatively illiquid assets that fund flows have an effect on the volatility of fund flows has an effect on cash to assets ratio. In the paper, we do a bunch of a number of robustness checks, looking that the results are not driven by small versus large funds or before or after the crisis. We find broadly similar results. We also look at a number of alternative explanations. So one would be that funds have higher cash holdings or say lower cash holdings when they expect future returns to be high or volatility to be low. Okay? Now you would expect that most of this variation would be at the objective time level. So there will be certain periods of time where everyone expects returns on, say, small cap growth to be high, and so all small cap growth managers basically have low cash holdings. Okay? So our results, our specifications control for objective time fixed effect, so it should pick up most of this variation. But for robustness, we also try controlling for future returns for the fund. That doesn't have any effect on our liquidity transformation proxies. Another alternative explanation is that concentrated managers may want to hold more dry powder to take advantage of investment opportunities as they arise. And perhaps this is also correlated with investing in relatively illiquid assets. Okay? We try controlling for it using proxies for following dry powder strategies, so concentration of portfolio holdings and the share of the top of the largest holding. These come in positively and significantly, suggesting that these types of funds do have higher cash holdings, but it has no effect on our key variables of interest. We also try to address the concern that maybe cash holdings reflect managerial risk aversion. We throw a bunch of manager characteristics. Those don't seem to matter at all. Okay. And getting to the price impact, so our model in most series would suggest that funds wouldn't fully internalize the price impact that they might have, right, when trading in the securities. We're going to try to think about settings where funds are more likely to internalize their price impact. One setting would be a monopolist. So to get at that, we're going to look at the fraction of the outstanding securities that a given fund holds. And the more of the outstanding that a given fund holds, the larger are going to be its cash holdings. So it's true for equity funds. We don't find this for bond funds, but for bond funds, it's a little bit more challenging to determine a priori which securities are closer substitutes as opposed to for equities. Okay? And then the other idea is to look at overlap in holdings between funds in a given fund family. So if I'm a fund and I'm deciding how much cash to hold, I know that there is overlap in my holdings with other funds in the family. If there's such overlap, I might worry that if I have to sell a lot of my own holdings, that will have a negative effect on other funds in the family. Okay? So when we try to measure overlap with other funds in the family, we find that funds that have overlap in holdings tend to hold more cash, basically as a precaution not to exert this negative externality on the other funds in the family. So far, I've been talking about cash as basically kind of like taking it as the only liquidity management tool that funds have available to them. In the paper, we discuss a number of alternatives, so lines of credit, in-kind redemptions, redemption fees, and inter-fund lending programs. In practice, it seems that funds don't really rely all that much on these alternatives, right? And our evidence suggests that in equilibrium, funds still rely on cash holdings. Okay? But we also showed that we get similar results when we split the sample into funds that have this alternative liquidity management tools in place versus the funds that don't have them. Right. And so to conclude, we take sort of like revealed preference approach by looking at how mutual funds manage their own cash holdings to help shed light on how much liquidity transformation they're engaging in. We find that funds, first of all, they use cash to accommodate inflows and outflows, and their level of cash holdings is driven to a large extent by how much liquidity transformation they're performing, so how volatile their flows are and the illiquidity of their assets. The kind of like two implications of our findings. One is that liquidity transformation in asset management depends to a large extent on liquidity provision by the traditional banking and also the shadow banking sectors, right? Because to provide liquidity to their investors, mutual funds have to hold a lot of cash and kind of cash-like securities that are supplied by these other sectors. And the other takeaway is that despite their size, cash holdings of mutual funds might not be large enough, right, to mitigate the price impact that they're exerting in the markets. Thank you.